The Real Estate Settlement Procedures Act, or RESPA as you might know it, is the #1 regulation overseeing the real estate industry. Anybody who works in a professional capacity within the real estate industry, not just the mortgage industry, but the real estate industry, which includes mortgages, is subject to the governance of RESPA. Not only must you be familiar with RESPA for safe exam purposes, but beyond that, it governs everything that you will do as a mortgage professional. So you must be aware of RESPA's implications above and beyond the safe exam. Good news and bad news. The good news is, in this video, I'm going to give you an overview of what you need to know when preparing for the exam in terms of RESPA. The bad news is to instruct you on all of the details of RESPA with which you must be familiar. That would take a bit longer than 10 minutes, but I do have additional resources for that I'll tell you about later. Let's start, okay? RESPA's purposes and origins, applications, exemptions, definitions, disclosures, document retention requirements, and general considerations are with what you need to be familiar for the SAFE exam. So again, the purpose of this video is not to give you a specific instruction on RESPA. Rather, I'm going to tell you what you need to know and how you can prepare for the SAFE exam in terms of RESPA and its applications. When studying RESPA, you'll need to know its purposes and origins, its applications, exemptions, definitions, disclosures, document retention requirements, and some general or miscellaneous information. But that's much better than reading the hundreds of pages contained within that regulation if you were to look it up online. RESPA has 3 primary purposes. Number 1, it requires itemized cost disclosure. So the Real Estate Settlement Procedures Act is a huge regulation to protect the consumer. And one of its main purposes is so that the consumer understands the itemized cost that they're going to pay in pursuing a mortgage transaction. Purpose number 2, it protects consumers from the adverse effects of kickbacks and unearned fees. RESPA says that any type of income you receive as a mortgage professional must be legitimately earned. And number 3, it provides requirements for managing escrow accounts. RESPA was implemented via Regulation X as an X-ray. One of the best ways to remember that is if you remove the S in RESPA and replace it with the X, the regulation letter that implemented it. RESPA pretty much sounds the same. So Regulation X is the regulation through which RESPA was implemented, and it was enacted in 1974. RESPA has 5 scenarios to which it applies and 6 scenarios to which it does not apply. You should know those. There are numerous definitions, and time prohibits me from going into the definitions of them all, but I'll simply read them off to you because that'll be something you'll have to study on your own. Affiliated business arrangement, agreement or understanding, application, associate relationship, balloon payment, borrower credit, bureau, business day, both precise and general, change circumstances, also referred to as a valid change of circumstance, dealer loan or dealer consumer credit contract, effective date of transfer, federally related mortgage loan, fee splitting and kickbacks, good faith estimate, HUD, HUD-1 and HUD-1A, which are applicable to loans not subject to the TILA-RESPA integrated disclosure rule. And number 18 is lender. Loan originator, manufactured home, markups, mortgage broker, mortgage property, origination service, person, prepayment penalty, and public guidance documents. Refinancing, Regulation Z, required use, RESPA, servicer, servicing, settlement, settlement service provider, also referred to as a third-party settlement service provider. Sham affiliated business arrangement, special information booklet, state, table funding, thing of value, third party, title company, title service, and tolerance. Now, I realize that that list might seem extensive, but I promise you that its bark is worse than its bite. As you prepare by studying the Real Estate Settlement Procedures Act, you will encounter many of these definitions, the meanings of which will become clear just through understanding RESPA better. There are 7 disclosures associated with RESPA. Not only should you be familiar with what they are and what they're for, you should be aware of their issuance and, when applicable, their reissuance requirements. We have the transfer of servicing disclosure, the special information booklets, both the HUD Home Loan Toolkit and the HELOC booklet when your home is on the line, what you need to know about home equity lines of credit. The affiliated business arrangement disclosure, you may also see it referred to as the ABAD. The initial escrow account disclosure statement, also referred to as the escrow accrual sheet. The aggregate escrow analysis and the terms behind escrow analysis, the homeownership counseling disclosure, and the mortgage servicing disclosure statement used for non-TRID applicable loans. RESPA document retention requirements are important to know pertaining to loan servicing disclosures as well as the affiliated business arrangement disclosure. Sham affiliated business arrangement. So an affiliated business arrangement is a scenario by which a mortgage broker or a mortgage lender, a mortgage loan company has an affiliation with a third-party settlement service provider, maybe with a title company, or perhaps it's affiliated with an insurance company. There's an affiliate relationship going on, and under certain circumstances, that is perfectly acceptable under the Real Estate Settlement Procedures Act. However, there are things known as sham affiliated business arrangements, which basically constitute either fraud or violations of RESPA. You should be familiar with the 10 factors in accordance with the Department of Housing and Urban Development to be used when assessing an affiliated business arrangement for legitimacy. General miscellaneous. Be familiar with the prohibition against kickbacks and unearned fees and penalties for violating RESPA Section 8 in particular, keeping in mind that a kickback is different from something of value that's exchanged between actual or potential referral sources. Both are prohibited under RESPA with certain exceptions. However, there's a definitive difference between what a kickback is and simply an exchange of something of value. Title companies have certain implications under RESPA Section 9, as do escrow accounts under RESPA Section 10. And finally, it would be a good idea to be familiar with RESPA's error resolution procedures. You should know the time frame by which mortgage loan servicers must issue a written acknowledgement of the receipt of a customer notice of error, the time frame during which the servicer is required to resolve the issue, and the terms surrounding that time frame's extension. If you are interested in a more complete and thorough overview of the Real Estate Settlement Procedures Act, please look at the comments. In there, I will post a link to a video through which I go over RESPA, basically telling you everything that you need to know when it comes to RESPA and the SAFE exam. Additionally, if you email me at the email address you now see on your screen, I will be happy to send you a link to where you can look up the definitions that I showed you earlier in this video. It'll make things a lot easier for you. I hope you found this video to be of value. Good luck.